Well, welcome back to the program. We want to thank you for sticking around. I know it's been a long morning, but I think there's been a lot of great information, and our guests certainly are impressive and have shared a lot of really valuable information. You know all of the guests, but we will go ahead and introduce them one more time, starting from, it'll be your left, my right. We have William Dunkelberg from the National Federation of Independent Business. Then we have Nathan Kaufman from the Federal Reserve Bank of Kansas City. Then Bob St. Peter, Dr. St. Peter from the Kansas Health Institute. And finally, of course, Jeremy Hill from the Center for Economic Development and Business Research. Now we're going to get right to the questions, and we're going to start with you, Dr. St. Peter. And this is a question concerning Medicaid expansion. Does the decision to not expand Medicaid in Kansas mean the $300 million annual federal subsidy is lost, or do these funds come to Kansas in some alternative form?
States that are not expanding the Medicaid program will not get those funds for other purposes. It's been an argument that's been made that the payments to states, the 100% payment by the federal government, obviously is being financed by federal taxpayers, some of which live in Kansas. So some amount of those federal payments for Medicaid expansion going to other states will come from Kansas taxpayers as well. But there will be no substitute payment, so to speak, to Kansas or any state that chooses not to expand Medicaid.
Okay, thanks, Bob. This one is for Jeremy or others, it says, and I appreciate the handwriting on this one, thanks. What impact does the retirement of baby boomers have on the total labor force?
Right. So when we first went into this recession, we saw the baby boomers wanting to exit, but they couldn't because of financial resources. Now the stock market has come up, and we've seen people leaving some of this market. So what is the impact? Well, you know, we're seeing that right now. I don't have the best of numbers to show it, but we're seeing some of them start to take some of the retirement. I think that's why we're seeing pressure on the management positions, some of the accounting positions that we have locally.
Nathan Kaufman, this question is for you. How has the Fed paid for the huge increase in assets since 2008?
So that was the short answer to that is that it adds a zero. Essentially what happens is, as it was explained earlier, we have bank accounts that have accounts with the Federal Reserve, and through quantitative easing specifically, what that is essentially refers to the program in which when the federal funds rate gets to its lower bound of zero, where you can't lower rates any further, you have to think about alternative measures of stimulating the economy through monetary policy, and that is quantitative easing. And so specifically, the Fed would start buying assets out on the yield curve. So it would go out in terms of buying long-term treasuries or mortgage-backed securities, and it pays for those securities by giving banks a credit. And so, as was mentioned in the first presentation, a lot of that has shown up in the way of excess reserves. And so there's been money injected into the economy, but it hasn't necessarily shown up in inflation yet because it's been sitting in those excess reserves.
Okay, Bill, this question is for you, and it concerns the commercial loan crisis. And it's you can kind of take some liberties with this. It says, JCPenney and Sears in trouble, anchors for large malls. What does this mean?
I guess they're in trouble. They're basically in trouble because consumers aren't spending. As we've documented, consumer spending has been really very slow. Even though we have 3 million more people a year, and this does help create jobs, as I pointed out in my talk, 3 million more people need haircuts. Well, maybe not all of them, because half of them are females, and you don't get just regular cheap haircuts like this. But the point is, there's a demand for more services. This creates more jobs and so on. Well, consumers have been very, very cautious. You saw the savings rates really low, but the income growth is really low. And so, we expanded a lot of capacity. Penny's and Sears are certainly one of those who have expended capacity in the past. But one of the problems that of course, Kmart had that too, is that they really, they built all those buildings, and Sears, of course, has been around for a long time, and Penny's has too. They built a lot of facilities that are no longer in the right place, so they're stuck with all of this older stuff that they have to try to get rid of. And so the transition is very hard for them, and retailing has changed. As you know, now retailing is just on your cell phone, right? You can buy most anything that you want on your cell phone. So that's really the issue. Those transitions are never delightful, and they're difficult finding somebody who wants to use an old Kmart store or an old JCPenney facility or an old Sears store is difficult. It's kind of, we have the same problem in the school systems. We have buildings that, I know in Philadelphia we've got tons of school buildings that nobody wants and are not used, and so how do you do that? That's difficult. Let me just do a follow-up comment on quantitative easing. So here was the idea, was to create a lot of liquidity. That is, as the Fed buys these bonds from you, it doesn't make you wealthier, it just takes an asset that was paying you interest away and leaves you with liquidity, cash. What we hoped was, of course, that you would invest the cash in other ways. So if we put the money in the banks would lend it out, and you would borrow money to buy cars or expand your business or whatever, and that creates jobs. But instead what we've done, obviously, is to buy other kinds of things. So gold prices are at record high levels and the stock market's at record high levels. So we've bought financial assets instead of buying real assets, and buying the financial assets, except for refinancing mortgages or doing things like that, doesn't create a lot of jobs, and that's one of the difficulties that the policy has faced. It hasn't been able to get us to spend the money on the things that the Fed wishes we would spend it on.
Nathan, we're going to jump a little bit out of order because we brought up quantitative easing again, and we've got another question. The monetary velocity declined as the Great Recession started in 2008-2009. Where is it now, and how will this factor influence the Fed's quantitative easing policy going forward?
Sorry, I didn't hear the first part of that question.
It says the monetary velocity declined as the Great Recession started in 2008-2009. Where is it now, and how will this factor into QE policy going forward?
So a lot of and what's been discussed is there's been a lot of uncertainty out there. And when you think about inflation is essentially too much money chasing too few goods. And what has happened is that it's not necessarily the money, the quantity of money is out there, it's that the velocity is down. In other words, it's not chasing the goods. A lot of that has been due to some of the heightened uncertainty that we've had. And it's been mentioned quite a bit here today. Until that uncertainty starts to get resolved, until consumers start to feel a little bit more confident about what the environment looks like, until small businesses or businesses in general understand what the rules of the game are, they're going to be reluctant to hire. So there's some of those sorts of things that are keeping uncertainty high, which is keeping that velocity down, it's keeping inflation low, and then that represents some implications for monetary policy, which factors into its discussions, both inflation and economic growth, when it considers policy.
Bob, got one for you. It says, is there a country in the world that offers universal health care that its citizens actually like? If so, what does this country spend on health care as a percentage of GDP? And I just read them as they're written.
There are a lot of countries that provide universal or near universal health care, and if you look at spending in the U.S. as a percent of the economy, we're at about 17.9% right now, and that is substantially higher than any of the other peer nations that we tend to compare ourselves to. In terms of the 16 or 18 countries that you might compare the United States to, our spending per person and our percent of GDP that goes to healthcare is more than twice the average of the other developed countries, and more than 50% higher than the next highest country from the U.S. So we are way outside the curve in terms of spending per person, as well as spending as a proportion of our GDP.
Could I get you to comment further on that? Do those countries ration health care, though? I mean, we don't ration health care. We kind of add it up at the end of the year and say, here's how much we spent. But in Great Britain, if you're, I may be wrong, I understand if you're over 55, you can't get dialysis, for example. And they calculate what they call a QALY, Q-U-A-L-I, like quality of life, and that determines what things you can get and can't get. And so one way or another, you have to ration the health care that's available, and we just have a different system than these other countries do.
I think that it gets very personal and sticky when you talk about individual situations. Certainly it's not a very good policy to ration health care at a patient's bedside. I think when you talk about macro policy and setting priorities as a country for what we spend money on, I would say that if you look at a curve of how much money a country spends on health care along the bottom, and as you spend more and more money, you go over to the right, and then you put on this axis health that's produced. It's a production function that economists love. If you look at that curve, as countries spend more and more per person on health care, the measures of health go up. I mean, it does matter how much you spend on health care. It improves health. But like all curves like that, that curve flattens out towards the top. And if you look at that curve, it actually exists comparing the United States to other developed countries. And we are way off that production function curve in what you would describe as an inefficient system. We're putting way more inputs, money, into the health system, and in terms of the outputs of health that we're getting, there was a report that just came out this year looking at health status in the U.S. compared to other countries, and it turns out, actually, this is important. And I'll just read. There are a couple highlights that I think are important out of this. This is a IOM commission study, and most people assume that we have a great health system in the U.S., and in fact we do for certain conditions, certain things. But this report from the Institute of Medicine came to the conclusion that Americans die sooner and experience higher rates of disease and injury than people in other high-income countries. This disadvantage exists in all ages from birth to 75. We do better for people that reach the age of 75. And it's even among advantaged Americans. When you look at the burden of disease and illness among even advantaged Americans, those with college education, of higher incomes that are not of color, those disadvantages exist across comparing the U.S. to other countries. And then importantly, among these peer countries, the U.S. is at or near the bottom in 9 key areas of health outcomes, including life expectancy at birth, infant mortality, how many babies die before their first birthday, injuries and obesity, and others. So I think that the real question, Bill, is not are we spending the right amount of money, or how much more or less should we spend, but what is the value that we're getting out of the healthcare dollars that we are spending? And I think that there are a lot of people that would agree that as a system, as a country, we are not at an efficient part of the curve in terms of getting benefit from healthcare dollars right now.
Jeremy, I have a Wichita question for you. It says, there seems to be a large amount of building growth with both retail and residential in East Wichita. What is fueling this growth?
So what's fueling the growth in East Wichita? Well, you know, that's an East and West question, right? I'm a West Sider, so I'm not going to comment on the East Side. Well, I've looked just recently at, you know, our sprawl, and there's a lot of sprawl going on. And I think, you know, when you look at the high-end growth, when I talked about, or the high-end residential growth, they're going to go to areas that fit that same residential perspective, and there's some opportunities on the east side, as well as on the west side, but they're going to move out, and because they have the opportunity, they have the income, and that's what's really fueling that. The high-income consumer here really wasn't as affected very much. They waited during the recession because they were worried about the uncertainty, and that's why we see high-end residential moving right now. I think that's what's really growing that, and that's why you see some of the retail segments really pushing out further towards both directions, really.
Bill, this one is aimed at you, and it says, the question is, how much has the bank regulators, FDIC, et cetera, contributed to the slowdown of the economy?
Well, that's been a very interesting and topical question in Washington for the past few years. If you go back to the 2008, 2009 period, the Treasury and the Fed and others really blamed the slowness of the recovery on banks' unwillingness to lend to people so they could spend money. And we've been fighting that. The charts I showed you show that just the reverse is true. People don't want to borrow money because they can't figure out how to use it, how to deploy those funds in a profitable way so they could repay the loan. And so it's really been demand that's been weak rather than supply. So we now know that there's plenty of money sitting at the Fed. And my little bank, we have excess reserves at the Fed earning 1/4 point. I would love to make a business loan, a small business loan, but nobody's coming in and asking for the money, so I'm earning 1/4 point instead of 5 or 6% on a decent loan. So that's really, I think, been the situation. There hasn't been a supply problem for credit. There's been a demand problem. Now, that doesn't say in the broader sense that all the problems that we had didn't cause the economy to crash, all the difficulties we had. The big banks, of course, were real culprits here with all of this mortgage-backed securities stuff. And the fact that the economy got hurt badly, I guess you could say, really came out of that. But the banks are out there. I speak to the banking organizations all around the U.S. They all tell me the same thing. We have money to loan, but we do not have enough people coming in and asking for it, supported by the data we have for 350,000 firms. So until we're more optimistic about the future so that these qualified borrowers come back in and are willing to take the risk, why we're going to see that the economy stays slow. But it's not because we can't get the money, it's because we can't figure out what to do with it.
I would just add one thing to that. We've been, a lot of what we hear about interacting with community banks, we do interact with a lot of community banks in our district, and there is concern about the regulatory environment. There's concern about Dodd-Frank and Basel requirements that look at having capital requirements being sort of a blanket requirement for a lot of different banks. And we hear a lot of community banks that are well capitalized, and they do that for reasons that they feel is prudent for their business model. Their concern is that in those small community banks, they do not have resources that some of the larger institutions have to devote time to identifying and filling out paperwork to meet these regulatory requirements. So there are some concerns in the community banks as it relates to those.
Yeah, and just to add to that, I think the regulators will be smart enough about that to understand that a bank with 500 million in assets, which is nothing, it's not the same as Citicorp and so on. And so you probably will see the regulators having really a different sets of regulations for the large banks versus the small banks that don't engage in trading and all these other kinds of activities. Banking is taking in savings from your market and lending it out to consumers and businesses in that market. That's what banking is about. That's what community banks do. And it's very different than what J.P. Morgan does, for example. And so I think eventually the regulations will straighten themselves out. They don't want to impair the community banks because they're so important to the small business sector of the economy. So, we worry about it. I worry about it as chairman of a little bank. But I think we'll get that all sorted out a little bit better than we'll see some of the stuff that Congress has to worry about getting sorted out.
We've got about 7 or 8 minutes left, so we'll try to get in a few more questions. And this one is open to anyone. Jeremy, that you might be best equipped to answer this. It's what's the percentage of job gains in the last 4 years that are temporary or low wage? Will that trend continue, and what are the outcomes?
Well, I don't know the numbers off the top of my head for the percentage or low wage, but we have talked quite a bit. The temporary agencies have been growing around here. The engagement of temporary agencies have been more significant within our economy because of the labor market that we have here with manufacturing, with other stuff. So it's been growing towards that. I don't know what the percent is of growth in those jobs are off the top of my head.
I'll make a couple of comments. If you go back to, I think, the June numbers, the June employment numbers, that was really before we started suspending parts of the ACA Act, putting them off. That was an important benchmarking period to figure out how many part-time and full-time workers you had. In that month, we had 356,000 new part-time jobs, and we lost 240,000 full-time jobs. So in a macro sense, those are kind of equal in terms of the hours that you get, and there's certainly an incentive to do that. A firm cannot pay more to a worker than the value that the worker brings to the firm, or the firm will go bankrupt. And of course, that's one of the issues that we have with the Health Care Act. We're not sure how much it's going to add to costs. But one of the things you'll see is that the benefit cost goes up. I can, as a firm owner, I can pay you less in take-home pay. That is, there's a total amount I can pay you, take-home pay, benefits pay, and that's really kind of the problem that we have. So one of the ways you can avoid that, obviously, is under ACA, is to get part-time workers rather than full-time. And of course, Congress will notice that, and they'll change those rules. Going forward, another way is temp employments, leased employees, and so on, where you don't have to pay these benefits. And so how that gets driven is really going to depend a lot on how we resolve these big benefits issues, in particular the health care benefit, which is a very important one.
Nathan, what is the future of federal crop subsidies, and what percentage of ag income is based on federal subsidies?
I'm assuming that question is specifically referring to crop insurance subsidies. And so the way that program works is the Farmers typically buy crop insurance, and that would be, a lot of them buy revenue insurance. Those premiums right now are subsidized at a rate, it varies, but they're subsidized at a rate of about 60%. So farmers are responsible for the remainder of that portion of the premium. In 2013, I think that payouts from crop insurance amounted to about $17 billion, which far exceeds the historical level of those payouts. There's been a lot of discussions, obviously, that remains a discussion. The Farm Bill is still ongoing with all of the talk about all of these other things at the federal level. The Farm Bill has kind of gotten lost. It has expired. It expired as of the end of September and needs to be renewed or something in place by the end of the year. Otherwise, it will revert back to something that's not particularly ideal for anyone. So this is something that people are talking about. They're looking at the ag sector. There's a recognition that there needs to be some sort of protection and safety net, but there's a lot of discussions and debate between the House and the Senate as to what that looks like. And some of it gets entangled because of the fact that the food stamp program is the biggest part of the Farm Bill.
Dr. St. Peter, how do doctors view the changes in Medicaid and Obamacare, and how do their views differ from large medical healthcare organizations?
I'm sure they all feel exactly the same way about that, and there's probably no way to summarize sort of the field as a whole. I think that, healthcare providers are in a profession. They're in this to do something worthwhile and that contributes. They make a living, and in our country, people in the health professions make a very good living. There's a lot of uncertainty out there about the future for them and their profession, their ability to keep their practices profitable and for them to maintain the lifestyle that they want. We've got lots of challenges in rural parts of our state, keeping an adequate supply of health professionals in those communities and making the delivery of high-quality services affordable in rural parts of Kansas and the rest of the country. I think that there are as varied opinions among physicians about the ACA and the Medicaid reforms in Kansas as there are among business people around the country. Some are supportive and some are not very supportive, but I think that in the 80s we learned that improving the healthcare system does not work without leadership from providers. I think the managed care era of the 80s, the physicians largely sat on the sidelines and insurance companies stepped up and tried to make things work and make the system a little bit more efficient, and patients and physicians both rebelled. And I think that there's an incredible opportunity for leaders in the health professions to lead as this change, the inevitable change in the health system moves forward. And I think that it is more encouraging this time that there is more leadership coming from the providers of healthcare themselves.
In our final 2 minutes, I'll open this question up to anyone. How will or how is the employee mandate of the ACA affecting small business recovery and growth?
The employer mandate, there's a lot of controversy about that. The employer mandate has been delayed for 1 year. That was one of the changes that's been implemented, so it won't kick in until 2015. But the question seems to be for companies that are around the number of 50 employees. Once you get above 50, you may be subject to a penalty if you don't provide affordable quality insurance to your employees. And I think there's been a lot of speculation about how that would impact hiring and converting people to part-time jobs. So it's 50 full-time equivalents, so that can be made up of multiple part-time people or some full-time people. And I think that I'd love to know what the business community does and what they tell us. Again, up to this point, there's been a lot of anecdote, but I think it'll be a very important thing to understand of how employers, small employers in particular, and large employers, how they're going to handle their whole health insurance responsibility going forward. And I think it's one of the big important questions that we really need to begin to understand and anticipate, because there are potentially big implications for our current health system depending on how employers respond to the incentives that are in the ACA.
The 50-person mark is, of course, an important one. So if you have 49 employees, obviously hiring the 50th employee can be very expensive because it changes the cost for all your others. But lots of business owners who have fewer than 50 employees also provide some form of health care insurance currently, and the issue for them will be, can they afford the required HHS package? That is, the government is now going to tell you what the minimum coverage will be. Our experience with states, I think, tells you that a lot of stuff gets thrown into that, and that gets very expensive. So for those firms, they'll have to figure out whether they can continue to offer or whether the cost of meeting the government's requirements for minimal coverage are so high that they have to abandon offering. And we don't know the answer to that. NFIB has a huge panel of 1,000 or two small businesses that we're now following through this whole process. We'll re-interview the same people, and so maybe in 6 months or 12 months we can give you a much better answer to what firms actually do.
Some of the anecdotes that we've been hearing, we have a number of business contacts around our district as well, and specifically in the manufacturing sector, we've had some contacts describe this scenario where there's a concern that they may be reducing hours from 40 hours per week to 29.5 hours per week, for example. And we've had some contacts that have actually said, you know what, in order to pay for 25% more employment, it's actually more costly for us to go out and hire another person. We're just going to work them overtime. So there has been discussions out there about what those labor market dynamics look like, and a lot of it still remains to be seen, but there are anecdotes that span that horizon.